Tom, thank you for being with us again. We appreciate it. We wanted to focus today on a subject that's been in the business headlines in recent weeks, and that is a new monetary policy framework that's been announced by the Federal Reserve. This is one of those subjects that's super important for the economy, but also kind of complicated and hard to understand. We're hoping you'll demystify things for us.
I will do it. Pleasure to be with you as always, Arthur.
Set the stage by reminding everybody, what is the dual mandate that the Fed has, and what is its core purpose and job as it conducts monetary policy?
Well, the Federal Reserve Board, which is now over 100 years old, has the dual mandate is basically they are responsible for trying to achieve price stability, which has been defined historically as not allowing inflation to run above 2% until the change we're going to talk about today, and maximum sustainable employment. So their job is to try and help facilitate through monetary policy maximizing employment while not allowing inflation to get too high, defined as above 2%.
In most people's minds for many years, those two priorities have been viewed as being in some degree of tension or conflict with each other. So if you optimize around employment, you bring the risk of inflation up and vice versa. Talk about why that's the case.
It is the case because most people who are of my generation, you will remember experience of inflation in our lifetime. And if you allow the economy to quote unquote, run too hot, you can drive employment levels up to a level where it starts to accelerate wages and starts to create other inflationary pressures within the economy. And inflation can then, go up at an exponential rate, and then it gets challenging to bring it back under control. So there is, in fact, historically, demonstrably, a tension between those two things. And so the Fed's got a tricky job here to maneuver the dials so as to try and achieve as much employment results as possible on the one hand, without, as I say, allowing inflation to get ahead of us.
So even though that's the case, recent economic history since the Great Recession of 2008 and 2009 has sort of changed how people look at that dynamic, correct?
Yes, and this is where it gets rather nerdy, but actually really important, because the economy is under a process of constant creative destruction. And the structure of the way the economy works today is quite a bit different than it was 30 years ago or 40 years ago or 50 years ago. And therefore, one of the most interesting things that's been happening during my lifetime is the average rate of growth of the U.S. economy and our principal peer group of industrialized democracies in the world have also been experiencing a gradual slowdown of economic growth. And particularly over the last 10 years after the Great Recession of 2008 and 2009, the level of economic growth has been quite tepid. So those inflationary pressures that we used to get decades ago are not manifesting themselves. And to put a finer point on it, government policy has been working pretty hard, particularly over the last 2, 3, 4 years, to stimulate faster economic growth pre-COVID, for example. But no matter what policy levers we pull, we can't seem to generate any inflationary pressures, right? And so despite the best efforts of fiscal and monetary authorities, we actually have more risk, particularly under COVID conditions, of deflationary pressures rather than inflationary pressures. And as I've talked about in other conversations that we've had, inflation is a tough nut to crack, but deflation is much worse.
Let's bring up the chart that we have here from the Fed that shows long-term growth projections for the U.S. You were just talking about this, and there's a couple of different lines here from both the FOMC and some other forecasters, but they all go the same direction, and they show kind of the natural growth rate of the long-term growth rate of the economy moving down from a 2.5% type of level to less than 2%. Why is that? What is causing these declines?
Boy, there are a lot of explanations. One of them is the great globalization process that's gone on in our lifetime, which is the opening up of the U.S. economy. We've become much more of a trading nation than we were 30, 40, or 50 years ago. the development of the Chinese economy and a great many other developing countries, which have become production platforms for so many items, have created the ability to source and supply all kinds of things that we consume in this country better, faster, and cheaper than we used to produce them ourselves. So the whole globalization process has driven up production, driven up efficiency, and kept a damper on prices, not just in the United States, but in the entire world economy. Now, that's one part. There's the internationalization and globalization part. But there are a whole bunch of domestic factors as well. If you look at the long-term demographic developments of the United States, the slowdown in population growth, the slowdown recently in immigration, the fact that the baby boomers are moving into retirement, GDP growth is a pretty simple function of adding more population, adding more resources, and producing more stuff. Well, if you're not adding people at the same pace and that's slowing down, that automatically flows through as less GDP growth unless it's completely compensated for by productivity growth, which it is not, right? So unless we change our demographics and start growing our population more quickly and increasing productivity, this is what you get.
All that's fantastic context for the change that the Fed announced. And we're going to get now into the nerdy stuff. I want to bring up a quote from Chairman Powell, and I'll read it, and then I'm going to ask you to translate this into English.
Non-banker speak.
Correct.
Yes.
We will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Yeah. What does that mean?
But what it means effectively is they will allow interest rates to be lower for longer in the future than they would have in the past, because they're more worried about deflation and slow growth than they are about their ability to control inflation in the future.
So if you're a corporate borrower or a consumer, what does that mean for you?
Whatever you thought 6 months ago, now you should be thinking, whatever my previous view was, now I think rates are going to be lower at these kinds of levels for longer than I thought before. And I shouldn't get too concerned when my Wall Street Journal reading data tells me, inflation's at 1.9% or even 2.1% for a month or a quarter, right? Remain calm. Rates are going to stay low for a while.
So that's good for borrowers. For banks, however, it is not so good. Let's bring up the last chart for the video. And this is a banking stock index that you can trade on. And it shows how bank stocks have performed this year, and you can see they've declined significantly due to COVID and stayed low. This is in contrast to what the S&P has done. Talk about that.
What the market is saying is whatever your value was pre-COVID in terms of the future earnings stream of your business, your future earnings stream came down a lot, and therefore your stock, your company, is a lot less valuable today than it was pre-COVID. Now, we don't have publicly traded stocks, so the market can't revalue us in this way. But we absolutely face the same kinds of challenges and headwinds that publicly traded stocks have, because the amount of earnings we can generate, for example, from our $10 billion of shareholders' funds is meaningfully lower than it was pre-COVID. So this is a great environment on the one hand for borrowers because borrowing is cheap, not so good for lenders of money because it's harder to be profitable as a lender. On the other hand, I would certainly trade 3 or 4% GDP growth with higher levels of interest rates than having effectively zero interest rates and de minimis growth.
Tom, thanks so much. Great to talk to you again.
Very, very much a pleasure to talk about these rather esoteric but important matters. Thank you, Arthur.